The way I'm going to start today is I am going to take you to the course website because I have a very important comment to make. There you have the lectures from yesterday and the day before. I will finish this today and there will be a new one, which is what I'm doing today. But it's a very important thing to point your attention to, which is this book. I don't know if you already know this book. It is one of the best books, in my opinion, on data science and machine learning and this and that. And it has many, well, it's written by great people. But perhaps what's most interesting is it's free. And when you go there, there's a whole website for the course, for the book, sorry. There's two versions of it, one which is a bit older, Introduction to Statistical Learning with Applications in R, and the slightly more modern version, an Introduction to Statistical Learning with Applications in Python. It's a great book. I'm going to use, when I become technical, I will use many things from that book. Things that I suspect you already know, but anyway, it's a very good reference for you. What is perhaps more interesting is that the book comes with a Python code that you can also download. And the really interesting part is that it has, well, these are what it covers, these are the authors. And what is perhaps most interesting, in my opinion, is that it, well, you have all the PDFs, even had lecture, you can teach the course, so the book is, the course is done for you already, okay? Is the data. It has a database available to you. So, I think it's here, online courses, I suspect, maybe there, okay? So you have data sets right there. It's fantastic. It's a fantastic resource, it really is. Now, the most interesting part of this book for my course is the data. And I already told you that in this course, and I'm happy to go through this again, is I expect you to write an essay, which is your own version of what the course was about. And this will be a great place for you to do things on your own that can really add a lot of value to your personal brand. Today, I'm going to use some of them, one of these databases for my discussion today. I'm going to talk about a credit card debt, a very important part of the world of finance. Retail credit is one of the big areas for finance today. And the reason is that we can do retail credit now better than ever before. It used to be the case before AI or before machine learning that corporate credit was the good business. Why? Because companies are very public. There's a lot of information about companies and people are very private. There was very little information about people. But now with machine learning and AI, the situation has changed. There's much more information about people than there is about companies. And this is one of the reasons why retail credit has become such a big deal. Okay. In case you're not convinced or you're not sure that there is much more information about people than there is about companies, as you probably know, there is many companies are in the business of getting your data. And in Europe, you have the data privacy law, which gives the illusion that your data is private. The fact of the matter, it's just an illusion. It is not, okay? And there are companies that track you completely legally in what you do, what you decide to do, what you're even thinking of. And we're going to be dealing with a lot of that today, because I've been released from some of the tension to having to finish on time, and I'm starting with the last hour yesterday. I want to expand that a little bit, and we're going to get a big introspection into how data is used today in the world of finance, which is drastically new. Perhaps I start with one case. It's a well-known case, and I like to talk about it. It is not in my notes because I don't have any data. I can only tell you it's been published in newspapers, but it goes a long way to explain the extent to which what I'm talking about is true. And it's a case that involved the company Walmart. You know Walmart? Have you heard of it? Right. So the situation was as follows, and I give you the mainstream media version of it. I don't have access to the insights. What I heard originally was a little bit different, but it goes as follows, and the details are not particularly important. It's the principle that matters. A man lived with his daughter in a house, and then he saw that Walmart was sending shopping brochures to his daughter with baby products in the front page. So he got very upset. His daughter was maybe 15 years old. So he went to Walmart. This is very American, right? And you sue everybody. So he went to Walmart, said that he was going to sue Walmart because, in his opinion, Walmart was trying to encourage his daughter to get pregnant. And well, Walmart knew nothing about that. I said, sorry, I mean, these catalogs are sent by the central office. We have no idea what this is all about, this and that. So managed to calm down the man, went home, and a few days later he discovered that his daughter was pregnant. Walmart knew before he did. How did Walmart know? Turns out that if you know your shopping habits, it's pretty easy to identify certain conditions, and in particular, all medical conditions are the holy grail of merchandising companies. And pregnancies especially, because pregnancies is the biggest economic elasticity part of the market. Okay, so companies, they spend their time trying to figure out who is pregnant. It's a business in itself. That is now possible because of AI. The impact of that has impact in everything, but the impact of that in the financial sector is major. Because in the area of credit, we have seen this immense flip between retail credit, where application for a credit card, for example, 20 years ago, when I first applied for a credit card, they asked you 5 questions, gives rise to a score based on 5 answers. That's all you knew. That's all they knew about you, right? But now, the information financial companies have about their customers is staggering, and these decisions are made with a very deep data basis. I will end this first section of my course today, what was going to be the last section of yesterday, with one example. That was the end. That's how I'll end. It's an example very related to that. It's a very famous business deal between Scotiabank, a Canadian bank, and Cencosud, a supermarket chain in Chile. Okay, I'll tell you about that. It's very, very interesting. So this is where we're going with this. We've been talking about investing of different types now, because I want to. Yesterday we reviewed the linear models, the Gaussian, non-Gaussian. We basically saw that the Gaussian linear models are fantastic. We understand everything so well. And with very little data, you can do wonderful things. We saw that. Then we saw that when you go to the non-Gaussian world, it's a mess. Nothing works. It's misused. And now that we're going to go fully non-linear, with enough data, we can draw a lot of very interesting conclusions. And this is affecting many, many parts of the financial market. I will try to restrain myself to the part of investing, but sometimes it's kind of hard. Like, for example, all the aspects dealing with retail credit spill over many of the funds that exist, because credit derivatives is a big deal is an area with very big spreads, which translate into very healthy returns. And retail credit has become one of those areas where data makes a very big difference. Okay, so having said that, put into context, I'm very comfortable now becoming mathematical and talking about these models. So allow me. By the way, I was thinking of telling you, so I come from UBS. I was there today, and it's very interesting when I'm there and then I'm here and I look at you and I look at them. I cannot help but making a very interesting reflection, and I'll tell you, okay, which is, and it's not about UBS, and I'm not going to remove this from the video. It's a general statement about the industry. The industry is very, of course, people know their business. Maybe they don't know what businesses will stay and will disappear, because they're all very nervous about what businesses will really stay, what jobs will stay. That's what businesses worry about, right? They don't worry about learning. They worry about staying alive. And these days, there's a very big relationship between learning and staying alive in business, okay? But they worry about staying alive. And learning is, they feel like they don't have time to worry about that. But they know the business very well. And they don't know the simplest things about AI. Okay? They are discovering ChatGPT right now. And they don't even know how to use it. They don't even know if they can use it. Okay? Then I come here and I look at you, and it's the opposite. You all know that. You're very good at that. And I can see that if only you could gain some business knowledge, which they already have, that will make you superhuman. And I know that because that's what I do. I turn people like you into business people, and I love doing that. So so I'm very comfortable being here, because I think it's easier to turn you into successful business people than take successful business people and keep them to survive. Okay, so if I wanted to give you that optimistic reflection about how I see your immediate future. So take that into account, okay? So and I consider that to be my responsibility, so I will do my best to help you do that. Okay. I'm going to now leave the linear world to deal with the nonlinear world, much more interesting, and the one that can really be adapted to understand what we want to do. And I chose this because I've been using this example for a long time, and I like it. It's a good example of how things work. Let's say that we want to understand the relationship between the size of a company and the volatility of a company. Later today, when I switch into my next topic, which is trading strategies, you will see that this fits very naturally into trading strategies. Many of them are based on that, this knowledge. So what's the relationship between a company size and the volatility of the company? This is a very well-known effect. It's been known for a long time, that smaller companies are very volatile and larger companies are a lot less volatile. We've known that. Okay? And if you've been watching the markets, this is very, very obvious. Okay, so I'm going to assume that this is the relationship we want to understand. It is a difficult question. We don't have very good data for this, especially for the smaller companies. Smaller companies typically come with very bad data. But we're going to ignore those issues. We're just going to see how we could try to understand that. Everything we did yesterday would not work. This is not, it would not work on the one hand because of the lack of Gaussian relationships between that, and more importantly because this is a nonlinear effect. Very simple linear effect. In fact, it's such a simple linear effect that people in the industry, they have been dealing with this for a long time without the use of AI. So this is, I'm using this is an overkill. I'm going to use machine learning to address this problem, which the industry has dealt with for a long time in their own way. And what they have done is they've split the data into ranges of different size. And then what they do is that within those regions, they just say, well, here, that's the volatility number, that's the volatility number, that's the volatility number. So this is well known. Everybody in the industry has been doing this for decades. What I want to do now is I want to mathematize that and tell you how we could do this. That will work not just for these two features, but for any collection of features where we perhaps don't have any intuition about what's going on. Okay, so what they do is they would split the data into ranges. The 500 million mark and the 5 billion mark, people who are in the business know that these numbers are significant. Okay, and they say, well, if you're a company under 500 million, the volatility is going to be around 40%. If you're a company between 500 million and 5 billion, your volatility is around 25%. And if you're a company bigger than 5 billion, your volatility would be around 15%. Small cap, mid cap, large cap. That's how these things are referred to in the investment lingo. Small cap, mid cap, large cap. And it's very interesting because sometimes you have a company that just crosses the range from 500 million and it went from being a company that was not very volatile to being a company that was very volatile. Why? Because now they fall into a different bucket and the sector deals with them that way. Now, you have a lot of expertise in dealing with data science, and you know that this is something that we can do with a tree, for example. A tree would be a very good way to establish these relationships. And so I'm going to continue with this intuitive approach, and then I will tell you, or maybe remind you, or maybe bore you to death, because you already know it, how trees are built. So every time you have this relationship, we have a breakpoint. A breakpoint is that boundary that changes one company from one type to another. So a breakpoint, in this case, there will be two. What goes between the micro cap to a small cap, we didn't talk about micro caps. What goes between a small cap to mid cap, I did talk about that at the $500 million mark. And then the $5 billion mark, which is what changes a company from mid cap to large cap. These are called breakpoints. And they're important even if you're not doing traditional data science. These are very important for machine learning applications because this is what tells you when something is about to change. For example, in the weather. If you want to understand the weather, a breakpoint is when you are changing from sunshine to rain. That usually signifies a breakpoint. Or in Canada, a breakpoint, very scary breakpoint, is when snow switches to rain. That's when we can get freezing rain, which is the worst thing we can have in Canada, for example. Okay, so breakpoints are very important elements to understand. And in this context of companies, it tells us when a company goes from one type to another. Okay? And this has been observed in finance for a long time. Now, if we were to do a tree regression, so there's different ways of doing this. The traditional way that you may have seen, people do piecewise linear regression. They take their data and say, well, I'll divide this data set into 3 data sets, the one for small companies, small caps, mid caps, and large caps. And then you do a regression for each of them. Do you picture that? If you've never seen trees, you don't know what I'm talking about. If you've seen regression, you can see how you could do it's called segmented linear regression, or a piecewise linear regression. And that will work very well in this context. The problem is you have to tell your data where the breakpoints will be. So if you know the breakpoints, then you can divide the data up and then do segmented linear regression in each of them. Clear, right? So the question is, how would you know how to do that? So I will show you how to do that. And this is how, first of all, trees are built, and then random forests are built. I'm not talking about random forests today, just trees. Now, this is something which is very easy to understand, and people have been doing this for a long time. It has some limitations. The limitations is that size is not the only thing that matters. There's other features that matter. But in the past, that's all you could have. And still today, we're going to talk about trading strategies in the second half of today. In trading strategies, equity trading continues to be the most popular one. And still today, when you are an equity trader, you're going to be asked if you are a small cap trader, if you are a mid cap trader, and if you are a large cap trader. And I've been doing this for a long time. And you're one of the three. Typically, managers specialize in one of those three company areas, and that's where they stay. Because the trading of each of those stocks is so significantly different that that's all they do. They stay there. It's very hard to find. But it's very hard to find managers, investors who specialize on all three. The considerations are very, very different. For example, later today, we will see that shorting stock is a very risky proposition, but it's extremely risky if you're dealing with small caps. Shorting large caps is much, much less risky, for example. Why? Because a small company can be taken over. Microsoft could decide to buy this small company, and they buy it overnight, and then the price goes up by 3 times. You're short, but no one is going to take over Google overnight or NVIDIA overnight. Okay, so that gives you a lot of stability. So the conditions are very different. Still, the industry today continues to be classified because of that. And this goes back to the old way of doing things. So now we're going to be able to develop methodologies to classify companies, to classify investments according to many other different features. The market has not caught up to that. But this is something which is very easy for us to do if we have appropriate databases. And we're going to be able to not only be able to classify companies into small cap, large cap, mid cap, but we're going to be able to do that according to sectors. Not all sectors are the same. Not every sector, small cap, mid cap, large cap, will be defined by exactly the same breakpoints or thresholds. We're going to be able to classify them perhaps as a function of the leverage within the company. Companies, capital-intensive companies and non-capital-intensive companies are different. If you are a large cap company, but 80% of your assets is debt, you're going to be much more volatile than if you're a large cap company like Apple that has zero debt or near zero debt, right? So liquidity is a very big factor, because if a company has a lot of volume when it trades, then has a lot of liquidity, then that will dampen the volatility. So the relationship between volatility and market cap is very imperfect. Volatility is a very big factor to determine that. Okay, and then you can add macro conditions. Even growth versus value will also introduce differences. And this, what I'm telling you now, the ability to do this before machine learning for the investment sector is science fiction. But now it's a reality. We can do that. And the methods I'm going to show you now is how these things are done. With tree-based methods, you can do that. You just need proper data. Okay? When I tell you the algorithms, I know that the algorithms you already know. I know that I'm giving you very little information when I talk about the algorithms. I know that. But I want you to understand how revolutionary it is for the investment sector the fact that you can categorize the relationship between size and volatility, taking into account these additional features. And you can do this yourselves. I'm sure you can download an algorithm from somewhere. You don't even have to write it yourself. And if you had access to a Bloomberg database, or even a poor Bloomberg database, with these features in it, you will have a fantastic way to classify companies. Much, much better than what the people out there, much, much better than what professionals out there do today. Okay? All right. So let me show you how. And again, this is the part that I'm sure you know, but I'm going to tell you in case you don't. I'm going to do it in the simple case of only company and volatility. Very simple two-dimensional picture where I can explain everything. But I will tell you that you will see in the algorithm that instead of you have more, you can still do the same. All right. So this, first of all, in case you did not know, this is the terminology for these terms, or these factors are called features. We call them features. These are the things which you typically find in a column in a spreadsheet that help you classify a company. So if you have, for example, the sector, that will be another feature. That feature is not numerical, it's a Boolean, or it's a discrete feature, because there's only certain sectors. If you have other things, all of these will be features. I'm only considering two features, so I can explain this thing more clearly. We could have considered stock returns and interest rates. That would give us a very similar problem, where we have also a non-linear relationship between stock returns and interest rates. It'll be locally linear, but when interest rates change a lot, then that's going to have perhaps a different effect on the stock returns. Okay. The key to providing a tree-based approach to doing our nonlinear regression is going to be on the use of the residual sum of squares, and works as follows. The objective is going to be to divide my data into subsets. And we're going to assume they're going to be rectangles because the algorithm is easier if they are rectangles, but it could have been any other geometric feature. I'm going to use rectangles. And you can see what the resulting grouping would be. I can have, in this case, I'm going to end up with 3 rectangles that will group my data into 3 groups. Each of those groups is going to be a homogeneous, consistent relationship between my features, volatility and company size. In this case, as you know, the intuition behind this is that if this is the classification I will end up doing, I'll consider all of the 3 green companies to be the same, all of the 4 blue companies to be the same, and all of the 4 yellow companies to be the same. My algorithm will tell me that with the data I have, that subdivision is good enough. And then I have 3 areas to work with. It's a nonlinear relationship. Yeah. And within it, I have a certain representation of each of those data classes or data clusters. How am I going to build them? For each of them, I call each of the data points x sub I. So I have 11 of them here, I believe. Okay, so there'll be 11 i's. And I have 3 rectangles. So for the number j that you have here, capital J is the number of rectangles, that will be 3. And the I within each rectangle, I have in one of them, I have 4, in the other one I have 4, in the other one I have 3. You picture that? Yes? Okay. And every x sub I in that formula is each of the points in my database. And the distance squared that I'm calculating there is the distance to the center of the rectangle. I know you've seen this before, okay? But I still have to go through this. Because, in fact, raise your hand if you've never seen this before. Okay, so I'm doing this for you. Okay? The rest already know. So please bear with me. So I want him to understand. Okay? All right. So I'm summing over 3 rectangles the distance from each of those points to the center of the rectangle. And the objective I have is to come up with a rectangular decomposition that minimizes that error that I have there. Okay? All right. Now, and I know that you already know this. In fact, you can give me, at the end of this lecture, you can give me a grade to see how well I know it, because you know this better than I do, okay? But this is something that we're going to do not with our entire database. We're only going to be doing this with a subset of our database that we call the training database. You may have a lot of data. We're going to build a tree that explains that data very well, but we're not going to use all of our data for that. We're going to use a subset of that data to determine what the tree is. We're going to call that the training data set. And let's say that it's 80% of the whole data that you have. You're going to save the other 20% for something else. For what? Even he knows that.
Validation?
Testing.
Yeah.
Yes, I'm going to use validation for something, but yes, you know, so even he knew that. So of course you all know that. Great. So I will use this on my training data set, and I want to reserve some part of my data set for the testing to see what I'm doing is good or not. And one type of training testing combination is going to be the cross-validation, which is what you're referring to, and that's coming up. Okay, so I'm going to do that, and I know that you already know that. I'm still going to go and do it in great detail, just in case someone is lying to me and doesn't tell me that you don't know this. All right. And the way we do that is through a method which is called recursive split. It's an algorithmic way to do this that works very well. Footnote, what I'm telling you here is explaining that book. Okay, what I'm explaining here is written in that book very well. We should take a break now. No? I continue? You sure? I don't want to break any religion rules, no? Okay, I don't. All right. So the way this algorithm works is, this recursive split algorithm is as follows. I'm going to use the brute force approach, which is the one that we will all understand. There may be computationally more efficient ways, but this is the brute force approach, which is you're gonna do as follows. You're gonna consider all possible combinations of features, and for each feature, a value. When you have a feature and a value, that allows you to slice your data into 2 halves, because a feature value defines a hyperplane. The feature is a dimension, and a value gives me the hyperplane. So when I have that, all of my data is going to be either above it or below it. A hyperplane defines 2 subsets of my data set, one, so to speak, to the right, and one, so to speak, to the left of that feature value. You picture that. This is the data to the left and the data to the right. If you have a data set in front of you, as for example a spreadsheet, then you pick a feature, I pick a value. Every data set with a value of that feature above it goes to the right. And every data set with a feature below it goes to the left. Okay? That gives you a hyperplane. Okay, so that, and we have infinitely many hyperplanes to choose from because there's a few features, 2, 10, a million, but there's infinitely many values for each of those features. So for all of those, we're not going to get into the algorithm, the optimization algorithm, but we know that there's many, many ways of doing that. But I'm going to pick the value of my feature and the value associated with that feature. In other words, I want to pick the column and the value in that column so that when I do my split to the right and to the left, and I find a representative value to my upper half space and to my lower half space, denoted by x hat R1 and x hat R2. X hat is the representative. You wear a hat because then people see you better, right? The representative, yes. When I look at the error, this is the mean squared error. When I look at this error, I do my split so that this error is minimized. That's how I decide where to do my split. And an algorithm will do this very quickly. Once. Okay? So you find what feature and what value gives you the least loss of energy or the least cost of doing the split. Great. So once you have that, you would do the first split, which in that case would be, for example, the green one. So everything that which is within, I know that there is values to the right and to the left. In this case, happens to be right and left. That would be my first recursive split. And then I go to each of the two resulting half spaces. And I do the same thing. For each of them, I find what is the optimal next recursive split. And I find that is for my values to the right, if I do the split exactly as we have it there. We're running the same algorithm on a subset of the data. And in this case, I'm only doing 2 splits, so I'm done. That's what I end up. That will be my second recursive split. Okay? Do you understand this? So you understand this if we could do this with many, many features, and we can do this with many, many recursive splits. Now, something that you probably already know is why stop here? Why don't we continue? I could continue and do another recursive split, and another, and another. And when I do that, what's going to happen? After I do 11 recursive splits, what am I going to have? I'm going to have 11 regions, each of them with a single data set, right? What would be the residual sum of squares if I do 11 recursive splits when I have 11 original data elements? It would be 0. There's a term for that. It's called overfitting. So we're going to overfit the data, and then of course the residual sum of squares is 0, and we may think we won. We may think that we have a perfect tree that explains the data. And this is where the testing data set comes into play. Again, I feel very silly telling you this because I know you already know, but I still have to do it, okay? We will feel very, if we overfit the data and we come up with 11 regions, each of them with a single data set, of course the residual sum of squares is going to be 0. Of course, it's going to work great on the training data set, but now we remember that there has to be a way for us to test what we're doing. And I think we don't have to be geniuses to realize that if we do this on the resulting overfitting tree decomposition, if we now apply that on a reasonable testing data set, it's going to behave perhaps not very well. So the way to prevent that from happening is by introducing some sort of a method to ensure that we do not overfit the data. And now that's difficult because now we don't know when to stop. I can say, well, I mean, I've done 2 recursive splits, shall I do a third one? And the way to decide is to introduce some economics into that. I'm going to say, do as much as you want, but you cannot do a recursive split for free. I want to charge you something for that. I could charge you computational time. Okay, if computers were very slow, then you would say, oh my God, another one, I have to pay another $1 million to do another recursive split. No, I stop here. Right? So the thing is, I want to charge you something for every time that you do a split. This is the way we avoid the overfitting the data. How much we charge, we don't know, but I want to charge you a cost per branch. Every time you decide you're going to do another recursive split, I want to charge you something for it. How much, we don't know. I'm going to call that number, I believe I'm going to call it alpha, okay? Yes, I'm going to call it alpha. So then what I have to do is I have to go to the original residual sum of squares, which is my penalty function. That's what I would like to minimize. But if I charge you alpha every time you introduce a new recursive split, the total cost is going to be something like that. Okay? Now, if alpha is very small, in other words, if it's very cheap to do another recursive split, you will do it. But if it's very expensive, you will probably stop. And the thing is that we don't know how much to charge. But we do know that if I charge a little, you will do more, and if you charge a lot, you will do less. Remember that. So we use then the cost factor alpha to decide how many of these trees we do, or the process which is called tree pruning. Pruning is to cut the branch of a tree. Okay? Every time we cut a branch of the tree, we save some money. So what we're going to do is, again, the brute force approach. Since this is all theoretical, I can run all of my recursive split algorithms with every possible charge per branch, and then look at what I have. For every possible cost, I have a different tree. If the cost is very small, I'll have trees with a lot of branches. And if the cost is very large, I have trees with very few branches. But we're going to do all of them. We're going to remember all of them. And all of those results will be stored in our database. And we know these very simple relationships. Great. And now, what we are going to do, and this is the part where this algorithm is I think, brilliant, is we're going to use the cross-validation now to decide what the optimal cost should be. So this is how we do it. I don't know the optimal cost. I don't know the optimal tree. I do know that for every cost you give me, I can come up with different trees. And I do this only on the training data set. The next step would then be to, and I will explain it and then I'll show you, is let me use now the testing data set, that 20% of the data set that we left aside. I want to use that to see how well all of these trees work as a function of alpha. And I will probably get that for alpha values which are very small with a lot of overfitting, the testing result will be very bad. And for values of alpha where the alpha is very expensive and my trees are very small, it will be very bad too. But maybe somewhere in the middle, there's a good number. That's how we're going to pick that cost. We're going to pick the cost that optimizes my out of sample or my result of my tree on the testing data. Okay? That clear? That's how we do that. So the cross-validation, I have an example here. If I have a what's called fourfold cross-validation, here what I would do is I would take my model and I take 75% of the data. I leave 25% to be tested, to be testing data. So on the 75% of the data, I train my model with all of the different trees, all the different branches, all the different costs, and I see which one does best on the validation subset. And that gives me the optimal choice for a model. And I can do this 4 times because I can permute the choice of the validation subset, and that's how I come up with my tree-based model. And you can do the 5-fold cross validation, and the result is typically something like this. You have a learning training data set results, which are always very good. Then you have the cross-validation numbers, which are always much worse. But then once you optimize that, you come up with the testing result, which is somewhere in the middle. And this is how you pick the best model, okay? And you will end up with a result something like that. This is after you introduce the cost, and then you can see that for very small trees, you get a very bad result. For very large trees, you get a slightly worse result, and it's somewhere in the middle. And that's how you decide the size of your tree. And trees are very good because they give us not only the nonlinear relationship with the data, they also give us an explanation-based algorithm. And for many decisions, this is very important. For example, if you are back to the retail credit, when you apply for a credit card today, loan, the banks will use a lot of data to make these decisions. And they know they can make very good decisions because they have a lot of data about each and every one of us. But the banks cannot just say yes or no when you apply for a loan or a credit card. They have to tell you why. And the answer cannot be, oh, I didn't give it to you because my algorithm said no. That's very bad for the customer relations. So they want to be able to tell you what caused that. And as you know, this is part of a very important part of AI, which is explanatory AI or XAI. In this particular area, tree-based approaches in finance are very useful because it gives, in this case, the credit card company, a very good reason to say why you do not fall into that population that should have a credit card or a loan. Very important for the financial sector. Okay. Now this it's not strictly investing; it's slightly outside, but you understand the purpose is very, very similar. Okay, we've climbed this hill. I think we can take a little bit of a break now. So we take a break, we come back, and then I will move to the next topic, which is the classification error. Okay. Fair. Okay. So this method of regression, tree-based regression, can be extended to situations where the features are not given by real numbers, they're given by Boolean variables, the typical problem of looking at a picture and deciding if it's a cat or a dog, for example. And the process is very similar. It is the process is very similar. The residual sum of squares is something which is now based on two Boolean variables, yes or no. And I'll go through this very quickly. It's very easy. True, false, and we instead of using the actual category, we just use a classification variable, which is a number which is either 0 or 1. And the classification error is now a number which is between 0 and 1. This is what used to be called fuzzy logic in the 1970s. And this is how we can do the same. There's three well-known objective functions which are used in this case. One is the error. You look at the maximum error that your classification tool would do, and this is one which seems to be good for large trees. The other one is the Gini index, which measures the variance of node purity, and lastly the one which is based on the entropy. And this is these are three methodologies for that. there's a wide range of applications. So what we have done, I started with the motivation of company size and volatility, which is very easy to understand, but this can be taken very far and wide into many different applications. I have some of them here. So we start with stock volatility. Credit default is the one that I mentioned. This is a big deal today, especially retail credit or loan approval. It can be done in the insurance sector. It is used on the consumer sector, but the probability of a purchase for a house prices, and that we know because the house price is it's explained fairly well based on a number of features that have to do with the properties of the house, how many rooms, where it is, in which country, the market, interest rates. So it's used in that. Salary expectations, you can use this on yourselves when you apply for a job. What should the salary be? You can do your own analysis on that. But the one that I want to mention here is the case of credit card defaults. And the reason I want to mention it here is because it's in the book that I showed you. And this would be a very good case if any one of you wants to use this as a training ground to develop some of these techniques that we saw here, and you're going to use that in your essay. This is perfect because it's already in the book. You need to look at the book, understand it. The data is there. I encourage you to not just do what the book does. The book is not a financial book. It's a data science book. So my advice would be take this and then use this from a financial perspective to draw your own conclusions. Okay, I encourage you to use this as part of your essay with the advantage that everything, the data, the algorithms, the code, everything is already done for you. And the way this works in the book, the credit card, the default is pretty good. It's very hard to get credit card default. They got it very good. I don't know how they got it, by the way. Some of the data they have, I know, very hard to get. They managed to do it very well. So they have a credit card defaults, and what I have here is the first classification attempt at that. There's only two features, which is the income of the credit card holder and the balance on the credit card. And then we see that the defaults are in red and the no defaults are in blue. And we see that obviously there is bigger probability of default when the balance is higher, less probability of default when the balance is lower. But it seems that across the income range, there's not a lot of variability. Seems to be quite constant. There's a very marked difference in the balance. It looks like the balance is an important feature when it explains default, but the income is not. By the way, there's a term that I don't think I'm using in this entire course, but some of you will know is the Sharpe value. The Sharpe value is a way to explain how relevant each of these features is. The Sharpe values, you know the Sharpe values? No? Oh, then I'll say something about that. Okay. All right. So we have that. All right. So the way this works, this is a. So I'm going to show you how this is done. We use a default. The default variable is represented by the letter Y. 0 is if there is no default, and 1 if there is default. And this is from the book. It's same terminology as the book. Okay. When you look at the book, you're going to find exactly the same. And then the first comment is we've got to obtain an estimate for the default by running a linear regression against our training data set. and assigning no default in the case that we have a number less than a half, or default in the case that we have a number bigger than a half. The number a half is an arbitrary choice, but this is something that we could do. The problem if we do that, by the way, I'm doing this to motivate the use of activation functions that I'm sure you already know because you've all done neural networks. But again, I'm going to assume that you don't, and then we will naturally arrive at that. Okay. If I do a linear regression between my default credit card data, then what I will end up with is something like that. I have my default on the top, I have my no default on the bottom, and when I do my linear regression, I will end up with a line. Now, a line is a very bad way to deal with probabilities because probabilities are always between 0 and 1. And this curve gives me a value which is below 0. You know, well, I don't care, I truncate it. Yes, but now you start to do messy things. So a better way of doing that is to follow a slightly different approach. I continue to use the default variable 0 and 1 if it is default or not default. But then I modify the linear regression so that I will come out with a predictor which is going to be guaranteed to be between 0 and 1. So I'm going to modify the linear regression to obtain a different type of regression. And then I will say that default will happen if the number is between, so I'll use a 0.5 as my breakpoint, okay, in the response. This is something which I can do by using what's called the activation function. I construct a mapping from the entire real line to the interval 0, 1. That's what an activation function is. And therefore, I can guarantee that all my probabilities that will be resulting from here are between 1 and 0. And the one that I think the book uses is the logistic regression, which uses the exponential or the logarithmic activation function. Okay? So in this case, this is the probability of a default that I'm going to use. You will recognize this as the logistic regression. You may have seen that. Exactly. Okay. So this still uses a single feature as the predictor, x, and the probability now is guaranteed to be between 0 and 1. So I'm using exactly the same principles as linear regression, but now mapped so that the resultant function is easier to characterize. And now in this case, I use this number p to be my response, and I do my estimation of the probability of default as a function of that, not a linear regression. So it's a very simple approach to obtaining credit card default from a single feature, which is income. Okay? There's that. And this is what's called logistic regression. And when you do that, this number that you have here is actually has a very nice interpretation as the odds of a default, and it takes values between 0 and infinity. And the linear regression that you do is in the logarithm of the odds. So you can use your linear regression package to come up with the parameters beta 0 and beta 1. Okay. And this has a name, it's called the logit transformation. Some of you have used in statistics the maximum likelihood estimator, I assume. It's related to this. The likelihood estimator is obtained through the likelihood function, and the likelihood function is nothing but the value of the probability function on the data set that's given to you. So the data set that's given to me, for those events that have a default, my default is given by that parameter over there, and when I have no default, it's given by my parameter over there. So the multiplication of both is going to give me the likelihood of my sample. The likelihood is a function of two parameters, beta 0 and beta 1, because I chose two parameters for my analysis. And you want to maximize the likelihood. Now, maximizing the likelihood is always challenging because it's a function which is very unstable. It's a product of many numbers which are close to 0, close to 1. The log likelihood is much easier, much more stable to optimize, and because the likelihood is obtained as a product of individual observations, the log likelihood is the sum of the logarithm of probability numbers. It's much more stable. That's why no one optimizes the likelihood. Everybody optimizes the log likelihood, which is now given to us as that expression there. And this is something which we can easily use to find the optimal parameters beta naught and beta 1 that will maximize the likelihood that my sample is represented by those two variables, beta 0 and beta 1. Okay, so this is how you would do this with a single feature, income, which is it's perhaps a very bad way to understand credit card default using income as a single variable. I already mentioned that 20 years ago you applied for a credit card with not one but 5 features. So clearly we can do better than that. But the thing is that the same method that we've developed here can be used now for as many features as you have. You just need to find a higher dimensional extension of what we have done to take into account more features. Okay. Before we do that, there's some reflection on the results that we have here. This is from the book. I did not do these exercises myself. They're in the book. I just took them from the book. I encourage you to do the same as you write the essay. Okay. But then I also encourage you to write perhaps new code to query the data with new questions that you have and put them into your essay. That's my advice. So these are the results that arise from that. I'll have something to say about these numbers here a little bit later. So let's say that I have a question then. What's the estimated probability of default for someone with a balance of $1,000 in a credit card? We can now answer that question because we've done the logistic the calculation, and in this case it's 0.6%. That will be the answer. Just get the parameters that we had from the linear regression and I apply it to this case. What's the probability if your credit card debt balance is 2,000? You do the same thing, it's the same parameters, and the answer is now higher. It's 58%. Okay. All right. Now, let's now amplify our feature space, and I'm going to include a new variable, a Boolean variable that may sound very close to you. Is was the credit card holder a student or not? And something interesting happens. Let's say that I change the income for the Boolean variable of being a student. And again, I did not do this analysis. It's in the book. And if you take the student as the predictor, what you have here is these are the results. And what we see here from the result for the coefficient, the beta coefficient for the student, is that students are more likely to default from the credit card sample. This is interesting. This is very interesting. And here I'm making a link with what I discussed yesterday. This is a very good example of misunderstanding the analysis that you're doing. We saw yesterday probably 4 or 5 situations where the analysis that was done was correct, but the conclusion was wrong. Remember? Well, this is the one case where the conclusion is wrong. What do you think is going on? If you only use the student as a feature, the result that you have is wrong because you're ignoring many other variables that matter. Okay, so in fact, let's see what happens if I introduce new features into the analysis that I do. If I now include two additional features into my analysis. So yes, student, no. I introduce the income and I introduce the balance. All things being considered equal, turns out that the probability of a student defaulting is actually less now. Our conclusion changes completely through the inclusion of new features. You understand what I'm saying? You understand what I'm saying? No. Say no.
No.
No. Okay. Thank you. Thank you. Okay. So let's see. Do you understand the meaning of the coefficient? The coefficient is when I do there was a logistic regression. So there's two parameters, beta 1, beta 2. Let me go up. I'm going to go to the simple case where I only have two parameters, beta 1, beta naught. Oh. I'm trying to establish a linear relationship on the logarithmic side. There we go. I'm parameterizing the probability with two parameters, beta naught and beta 1. Right? So beta 1 tells me the sensitivity of that variable to the feature. And a beta naught is the intercept. It is like the alpha is if you are above or below the predicted value coming from the feature beta 1. So if beta naught is negative, sorry, my dyslexia is kicking in now. If beta naught is negative, that means that this feature would give you a smaller probability of default. And if beta naught is positive, it will give you a higher probability of default. It shifts the probability of default up or down. I think I got it right. Yes? So beta naught being positive would shift the probability up. You're more likely to default. And if beta naught is negative, you have a smaller probability of default. It pushes the probability down. Yes? Yes? Good. Okay. So in that case, let's now go to the result that we obtain. So I said here, the student has a positive beta naught, so has a higher probability of default than you would expect. That is entitled because of that particular feature, which is student yes, student no. So if this is the analysis that you do, the conclusion is that being a student should increase your probability of default from the data. The conclusion I'm saying is wrong. It's wrong. I'm going to show you what the right one is. It's wrong, and the reason it's wrong is that there are other features that have a bigger explanatory power than being a student. So these students in the sample just happened to have other features which are more relevant, and it's not really related to the fact that they were a student or not. And I only see that when I look at my augmented analysis with additional features. And now I see that the probability is negative, exactly. So being a student actually makes you less likely to default because the driving variables are the other ones, income and balance. So what probably happens is that students have lower income, and what makes them default is not the fact that they are students, it's that they have lower income, as represented by the income row over there. Okay? And this is important because it goes back to the perils that I mentioned yesterday of doing analysis without really understanding the analysis that's been done behind it. If this is done by an agent, for example, so you have no control over what's going on, and the agent just gives you the answer, then the answer is the wrong. Well, here's the right one, but the previous one would be the wrong one. And
what happens with the income because the p-value is more than 0.5?
Yes. So it is, I didn't look into the p-values. So the income is not a good predictor. It has very low explanatory power because the p-value is very large. So maybe this is wrong too. But but what I wanted to highlight is if I do this regression here, I get the exact opposite conclusion about the impact on default if you're a student or not. And this is something important to be aware of, which is what I said yesterday, and I'll say today, and I'll probably say every day, which is it's really hard to do these things. It's very easy to be wrong. It's actually it's easier to be wrong than it is to be right. And with the arrival of these black boxes that come from AI, it's more important than ever that you understand what's going on and don't just rely on the values which appear here. And that's why in this particular case, again, I gave you a lot of freedom for the essay. You can do whatever you want. And I know that this is very confusing to many of you. I know, because you're not used to that. But this is what I want you to do. I want you to play with this. This is the only way to learn. The only way to learn is to query the data yourself, interrogate the data yourselves, use different methods, understand the results. Like, for example, your comment about the p-value being high. That's a very good question. I actually don't know the answer. I seem to remember that the book mentions that, and they have some way to address it, because I remember when I read the book. I don't know. Yes?
Yeah, it just means that it's insignificant, so we actually cannot interpret the coefficient.
Correct.
So,
Exactly. Yeah. So yes. So will that affect my conclusion that being a student has a smaller impact on your probability of default?
you can still interpret the student one because that is the significant.
Exactly. Yeah. Exactly. So that's what I think. But frankly, I don't know. And if I was you, if I was especially you, I know what I would do for the essay here. I would spend all my time explaining what you just told me about the p-value, right? Because this is the real art of using anything related to machine learning or even AI in this context. You need to understand all these things. And the answer is not just yes or no. There's a lot of additional values to look at here and to understand correctly. This is not easy, despite the fact that many people think that data science, AI, machine learning is magic. You just get an answer all the time. Yeah, you get an answer all the time, but very often it's wrong. As we saw earlier with my first example, with a single feature, right? If by the end of my course, I get you to be very skeptic about the use of machine learning, I'll be wonderful. That's my objective. Be very skeptical. But at the same time, feel very powerful, because you'll have the ability to drill down and understand what things mean and to perhaps prevent some of these conclusions to get you to the wrong answer. Okay? All right. So this was the highlight of what I wanted to mention here. There's more things. Again, this is from the book. There's some further explanation about the student status versus some of the other parameters. And I think I'm going to move away from that. I want to now extend this. I want to use this as a way to get into neural networks, and that's the next thing I wanted to tell you. Yeah. So. I'm not going to talk about this. I want to go. Yeah, I'm going to jump over this. Maybe we cover that in another lecture. I want to continue and extend this, or not extend this. Look at the same problem we did in a different way with a different methodology, And in fact, I'm going to use a neural network for that. And this is closer to the business case I want to discuss today, which is the Scotiabank Cencosud deal. So here what I have, and this is something which we're going to do by hand. I'm going to do a neural network for you by hand. Because then I'm going to go into the supermarket bank business deal, where I cannot do anything by hand, but I want you to have the understanding of what we can do from here. Okay? All right. So I have this data set. It's the simplest data set I could come up with and the simplest neural network I can build. But this we can build by hand. This is my data set. I have 4 individuals, Alice, Tom, Anna, and David. They have a certain income, 100,000, 200,000, 100,000, 150,000, a certain age, 20, 60, 40, 30, and 2 professions. There are 2 of them are teachers, 2 of them are lawyers. That's all the data I have. What I want to do now is I want to build a system to decide if a 5th person given to me, given the same parameters, is a lawyer or a teacher. I want to build a predictive model to tell me if the next person coming into the room, you tell me the salary, tell me the age, I'll say if he's a lawyer or a teacher. Okay? That's what I'm going to do. When I tell you about the business deal, it's exactly the same situation and almost exactly the same conclusion. But I want to do it here, and then I'll tell you how far we can go with this. All right, so the way to do that is I'm going to use the sigmoid, which is very similar to the one that we used earlier. It's related to the logistic regression. This is going to be my sigmoid. And this is going to be my activation function. I'm going to build a neural network. It's related to what we did earlier, but it's a neural network. And this is a neural network with it's a depth 1. So it's already a case of deep learning. Very simple. The simplest I could do. So I have my input layer. Take a break, yes. Take a break, no. I continue that. All right. Yeah. So the input layer is the information I have. Is this actually? You know what? I think I'm going to tell you the business deal. Yes, I'll tell you the business deal. Then I'll walk you through the neural network, making a reference to the business deal, and then I'll tell you the business deal again. Never done it like that, but something tells me that it's perhaps the right approach. So the business deal first. This happened in the year 2015, I'm guessing. A Canadian bank, Scotiabank, is the Bank of Nova Scotia. It's a bank which comes from the province of Nova Scotia in Canada, in northeast Canada, and it's called Bank of Nova Scotia because in that province of Canada, a lot of the original settlers were from Scotland. So they called them Bank of Nova Scotia. Very good commercial name. It was actually, they were Ireland, Irish people, but Scottish too. So anyway, doesn't matter. Bank of Nova Scotia comes from the province of Nova Scotia. And this is a bank which is, the Canadian banks have, we don't have very big banks, but this one bank is, even today, still today, has a very big presence in Latin America, in Mexico, Colombia, Peru, and Mexico, Colombia, Peru, Mexico, Colombia, Chile. In fact, this was in Chile. This deal was in Chile. So the way they got into the Chilean business was they did an agreement with the supermarket chain. And I am assuming the supermarkets here are the same as everywhere. When you go to a supermarket, you can sign up for what they call the loyalty program, right? Yes, you've been there. Some of you may have the loyalty program in one or several supermarkets. Yes, okay, I do. All right, good. What is that? The loyalty program in a supermarket is a system by which you tell them things about yourself, which is what? Your name, your age, where you live, maybe your profession, maybe your income. Okay? They get that. And that data that you give to them, they never check. So you could be lying. And they know. But then they get the really good data, which they know is true, which is what you buy. You cannot lie, they know. Unless they make a mistake, they know that data is correct. So that's a very interesting collection of data. One which is voluntary that you give them, and they know that is probably not true. You could be lying on that. They have no way of checking. They don't want to. And then they have the data that they believe is true. What you buy, where, how often, this and that. Okay? All right. So Bank of Nova Scotia said, we're going to get into the credit business in Chile. For a bank to do that, requires you go there, you have to create a bank, pieces of paper here to the regulators, wait a few years, you get the permission, now open the branches and start the business. Takes years and takes millions and millions of dollars. Or they do a deal with the supermarket. And the deal with the supermarket is, hey, supermarket, I don't know which supermarket does this here. Is there a supermarket here that does that? Give me a name. I don't know. I don't know Swiss supermarkets.
Migros.
Migros. Okay. First time I hear this name. Okay. So they go there and they say, let's do a deal. I will give a loan up to $300 to every one of your customers at the checkout. So you go there, you buy your milk, your groceries, your strawberries, whatever. You go, you pay. I said, I want a loan. I said, okay, how much? 200 Swiss francs. In 5 seconds, you get a yes or a no. Okay? And the loan comes from the bank. And the bank did that. It's a very fast way to get into the business, right? You don't need branches, no regulatory approval, just a deal with the supermarket. The supermarket is happy, and the bank is happy. Understand? They did that. Now, when you do that, it's a loan business. We already went through that. It's very similar to the credit card default that we mentioned earlier. This is not a credit card, it's a loan, but similar. And forget or don't think that being $300 is very small amount of money. $1 is a huge amount of money to a bank. They don't want to lose anything. Right? They're taking a risk. So they use the data that the supermarket has to manage that business for them. And there what's critical is how can you use the data that the supermarket has to decide who to give a loan to. And now the data they have is of two types. One is the data which is volunteered, which could be false, and the data which is generated, which is true. Yes? It's a very interesting decision. And they built a system, and what I have done here is I built a caricature of that. I built a neural network that is going to guess if you're really a teacher or really a lawyer. That's all I'm going to be doing in my simple neural network. But I want you to understand that the same thing I'm doing here with a larger database could be used to do some very good customer profiling. You're a lawyer, you say you're a lawyer, but then I see what you buy, and I see where you shop, you're not a lawyer. I don't give you the loan. Understand what I'm saying? These are the businesses that are thriving today, and they think like that, they act like that. And everything we saw today is used in that process. So what I'm going to do here is I'm going to create a predictive tool with a database of 4 and one hidden layer in my neural network to decide if people are telling the truth, to decide if I'm going to give a loan. And by the way, in doing that, I will create our first neural network, which I know, you have seen and you have used, but I want you to see it thinking, knowing that the business implications of this are very, very important. Okay? That's why I've never done it like that, because usually I use this to explain to people what neural networks are, and then I explain the application. But you already know what a neural network is, so I won't bore you if I just show you this. But when I show you this, I want you to understand how this would be used in a situation where you have the whole supermarket database, not just 4 data points, but which, by the way, it includes not just the data of that particular customer, includes the data of all other customers, because that's very important for cross-validation purposes, right? You understand what I'm saying? This is real business now. This is real business. Okay, so let's do it. This is a caricature, okay? I only claim I know your salary and your age. You tell me that. And then I want to decide if you're a lawyer or a teacher, which in practice would be I give you the loan or not. All right, so you know how that works. I could say the hidden layer, the way I think about the hidden layers is I have 2 features, salary and age, but there may be others that I don't know that are relevant. I don't know what they are. Where you live, I don't know. I don't know where you live, and I don't know if it matters. But let's say where you live is that H1, which is hidden because I don't have access to that. And the other one, let's say I have have the salary and the age. I have here, I don't know, how often you buy milk. I don't know. Lawyers and teachers, I don't know that there's a difference, but let's say that there's another difference to when you buy and where you live. And both of those things are things that are in my database. But I don't know what they are. So I let the system pick what they are, because I don't know, and that's what the hidden layers are. These are features that may be important, but I don't even know what they are. That's how I think about the hidden layers. Not just algorithmically defined. They are a reflection that even if I think very hard, there are things that I cannot even imagine they are relevant. Why would I decide if they are relevant? Let the machine decide if they are relevant by looking at the database. So these are the unknown features that may be relevant, but I don't know. And then I have the output layer. The output layer is default, no default. In our case, is teacher or lawyer. Okay? Understand the variables? Great. All right. So the relationship between the hidden layer and the input layer is that the hidden layer should be a function of the input layer, because it's the only information I have. So the hidden layer, my number H1, which I don't know, is a made-up feature, made up by the system, not by me, is going to be a linear combination of my input layer, the things that I really know. And linear because it's the simplest thing I can come up with. I will use my activation function to make sure that it's within the right band that I work with, just like with the probabilities earlier. You all have built a neural network before, correct? Yes, you all have. So this thing I'm telling you, you've already seen years ago. Great. But now I want you to think about this with the Scotiabank deal in mind. Okay? These are the features that the bank would care, but they don't even know what they may be. But there will be a function of the input they have. And of course, the input layer for the bank is not just these 2 things. It's all of that infinitely long list of things that people buy in the supermarket. So the input layer is very large for them. Very large for them. Huh? Every transaction that happened will be in the input layer. Okay. And then there are some weights that I introduced that may shift the probabilities up and down, or the features up and down. Those are the weights that I have there. They shift things up and down. And then everything is shipped into the output layer, which again is a linear function of everything else after I apply my activation function. That's it. So again, the roles is, this is the data I have. This is the data I don't have, but it might be relevant. That's why it's a hidden layer. And the output is the data I have. I'm going to use this on my training data set. In the training data set, I know the O1, I know the output. I know who's a lawyer, who's a teacher. And everything is a function of a lot of variables that I have there. I don't know how many, many of them. And the activation function ensures that what I have there is in the interval 0, 1, as it's supposed to be. Okay? All right. So if I, what am I doing here? So how do we train the neural network? So the way we train the neural network is I have all the parameters and I calculated that in this neural network I have 9 parameters. So I have 9 parameters which I will train on a data set of 4. Grossly over parameterized, but that's how neural networks work. They have more parameters than data sets, right? Then I'm going to seek for vectors such that the output of my neural network matches the training data set result as closely as possible by minimizing the mean squared error. If the mean squared error happens to be 0, then it's great, I have it. Perfect. On the training data set. And how do we do that? For example, I can start with a trivial solution, which is I decide that everybody is a lawyer. What happens if everybody is a lawyer? Well, that's the data I have. I say 0 represents lawyer, 1 represents teacher. Then I see that the mistake I'm making there, the error I have is 0.5. Than the mean square error. Can I do better than that? Can I have a better guess as to what everybody is? And then as I do a better guess, then I'll have a better choice of parameters. As simple as that. And there are methods, you may have heard, the backpropagation, to actually come up with the optimal parameters that optimize the matching I have represented by the mean squared error. That's where a neural network is. Works? Great. So in this way, I train my neural network, and that gives me a way, I think I'm done with this, and that gives me a way to predict the answer I'm looking for. Are you a teacher or a lawyer? Or in the case of Scotiabank, are you good credit or bad credit? Are you lying on your applications and you're a lawyer and you're not, you're a teacher? Or what, right? Understand? Okay, so I'm done with that. I think I can move that. You already know that. And now I'll tell you the deal. This is how the deal worked. So, bank in Canada, supermarket in Chile. And this is the beauty of it. For me, the beauty is in the business case. The beauty is the Canadian bank gains access to the database of the supermarket, and then at the checkout counter, customers can ask for a loan up to $300, and then this information is shipped. And I don't know if the whole database is shipped or the bank developed the neural network that will operate here. I don't know that. I have good contacts at Scotiabank. They told me about this, but I don't have any confidential information. This may be even known. I haven't asked ChatGPT. Maybe this is known. I don't know. Not important for us right now, because we only care about the data science aspects of this. We don't care about the business who owns the data side of things. But I do know that the bank had 5 seconds to respond with a yes, no. And if the answer is yes, you get the loan, and if the answer is no, you don't get a loan. And that business is managed by a neural network very similar to the one that developed here with our bare hands. Okay? And that's how you deal with the nonlinear, non-Gaussian, lack of parameter situations in finance. Finance and everywhere, but I'm interested in the finance. Okay? Great. So Now we take a break. We've climbed a very steep hill, and now we take a 15-minute break, and then when we continue, we'll do something different. Trading strategies. So first, I want to start by reminding you something we did yesterday. It's a very important analysis of what I call alpha-beta separation, actually what the market calls alpha-beta separation, but it was very important because it helps us understand that there's two types of managers, two types of investment strategies. One that seek a certain index, perhaps with an outperformance, and which seek alpha, typically by doing something smarter, doing things which are perhaps not as regulated, things that include doing things which are very innovative sometimes. We saw on the first day we did something extremely unusual for an investment product. We created a snow swap. We created a derivative that doesn't exist, one that cannot be priced, with over-the-counter contracts that Simone was the one doing working that for us. But the result was wonderful. We obtained 7.2% after fees, and everybody was making money, right? It was great. Most mutual funds that they are very different. They can only do ABC. They have to be fully invested. They have very little freedom as to what they can. And then all the mutual fund managers are competing with each other to see who can get 10 basis points more of return by doing this or by doing that. There's very little things that they can do. And yesterday we understood why, which is the world of beta is driven by these very heavy eigenvectors that just pin your performance down to indices. Whereas if you're free from that, and you can manage your portfolio in the part of the frequency space, which was where the noise lives, then you can do wonderful things. That's what we saw yesterday. And this is how the world works. In the strategy description that I will be doing today, I'm going to be focusing more on the hard part, which is the alpha, knowing that the beta part is somehow the easy one. And we saw that yesterday. Okay, I forgot who my two traders were, but that's what we did yesterday. Remember that. That's a very good example. I told you, you need to remember that example. All right. So, and that's where a lot of the innovation happens anyway. And a lot of your competitiveness in the investment space will be there in the alpha production. Because we also saw yesterday, if you do beta, you better give your portfolio to an alpha producer and spend your time selling. And by the way, if any one of you wants to make the big bucks, go into selling. That's where the money is. And in this day, good AI will help you in the selling part too. Okay? But my course is not about that. But at least it's in the understanding of what you can produce by investing with good knowledge. Now, I have here examples of many different trading strategies, some of which I will mention today, some of which I will not. But what we can see in this risk-return scattergram is that the risk-return profile is really all over the place. All over the place. Of those strategies, I have many of them here. Most of the activity that happens is on the equity space. So today I'm going to talk about trading stocks. I suspect that's all I'm going to do today, trading stocks. And then I suspect tomorrow I'll be talking about trading other types of things like bonds, for example. Convertibles, I'll spend some good time on convertibles, which are bonds with an option, very interesting things. And then I may, depends on how we feel, we may go into some macro trading, some other stuff. We will see, we will manage that. But today, I think I will restrict my attention to the equity world only, okay? And talking about equities, I'm going to divide it into three parts. I want to talk about equity long, equity short, and equity long and short, where the magic happens. We'll see the magic today. Well, if I have time. If not, we'll see the magic tomorrow. Okay. When you do that, there is two basic methods to invest in the market. One is to fundamental trading, and the other one is to growth trading. Actually, one of you was talking to me about fundamental on the crypto. That was you. Yes, exactly. So this is one of the, it's a ground up. I analyze things very well with pencil and paper sometimes, right? And then I make my decisions based on that. I mentioned to you yesterday, this is what started about 100 years ago. Once investors had reliable data, very small data sets, but reliable, then you can make investment decisions. Now you have a lot of data, which is not very reliable. Some of it is and some of it isn't, right? How reliable is people talking in Wall Street bets about what they're going to do? There could be bots, you don't know. But we have a lot of data. But when you have a little bit of data and it's very reliable, that's where fundamental trading works, okay? Growth is a version of that was developed around the year 2000 because investors realized in the year 2000 that the fundamental way of investing doesn't work anymore. Because the best companies were these tech companies that looked awful from a fundamental accounting perspective. A company called Facebook doing an IPO with zero revenue. You've never seen that before. Which told investors, you better look forward. You have to make predictions into the future. Oh my God, how do you do that? We're going to see that today. But in doing that, we're going to start, well, you'll see. And then we have GARP. It's growth at a reasonable price, because then investors realized in the years 2005 that growth was good, it was risky, so oh my God, maybe a bit of both. That's what investors were doing. And then momentum trading happened. And momentum trading, I have a good example of that here. Netflix was one of the first momentum trades. Netflix happened at a very interesting time. The competitor of Netflix was a company you've never heard of, called Blockbuster. Blockbuster was a fantastic, very interesting company. I love to do the business case of Blockbuster. That was in the day when there were tapes, not even CDs, right? And well, they made a number of wrong business decisions, and in 2008 they died. And that was the time when streaming, actually Netflix was doing business without streaming. They were doing, the first business Netflix was doing, you know Netflix, yes? Okay. The first business Netflix was doing is they were sending CDs by mail to your home. Yes. And the big thing for Netflix is that you could keep the CDs as long as you wanted. The only restriction is before you get the new one, you have to return it. Which was a big revolution because Blockbuster made 40% of their revenue on late fees. This is what we're talking about. This is the ancient space, okay? This is the prehistory of time, right? When Netflix came up, but then when streaming started to be the thing, then investors say, oh my God, this is Netflix, it's going to be fantastic. And then it became a momentum trade because every investor wanted to buy it. 2013. And even the CEO of Netflix admitted that it was the target of a momentum trade. Usually, if a company goes up in value, the CEO says, oh, I'm a good CEO. Because of me. But Reed Hastings said, no, this is a momentum trade. Nothing to do with me. People just love the company so much and everybody is talking to each other and this and that. Now, momentum trade, there's the first two styles that I mentioned, fundamental and growth, they've been there for, fundamental for 100 years, growth for 26 years now. And they are largely unchanged, although we will see what we can do with good data, with good AI. We will see what we can do there. GARP is really an in-between topic, is not important for us. But momentum is very important. It's been around for a while, but momentum is reborn. We talked about that on the first day I know, but now it's time for me to mention that again, because momentum is now changing dramatically. It's really all around us. And I am of the belief that momentum, understood or relabeled as social finance, is going to be the big driver. I have two examples of that. GameStop and ESG. I'll talk about GameStop, which I assume you know. You know GameStop? Who does not know about GameStop? You don't know GameStop. Okay. Then I should tell you. There's a company called GameStop. It was a very popular store where gamers, people in their teenagers around the year 2020, went shopping for their video games, and they were all the same. There were stores in shopping malls. They had no online presence, no streaming. You had to physically go, get in your car. Some of you were teenagers, maybe on a bus. In America, it's very hard to get on a bus and go anywhere. And buy that game, take it home, put it into your PSP or whatever, and then just play with it. And someone had the view that that store, that business was doomed in 2020, 2019. 2020, no business plan for online presence, no streaming, nothing. So a big hedge fund decided to short the company. Malvin Capital decided to short the company. Turns out that, you know Reddit? Yes. So on Reddit, there's a group called Wall Street Bets. And some teenagers there said, "Oh my God, how dare you short my GameStop company? It's like shorting your grandmother, right? So how dare you?" They had an emotional reaction to that. The emotional reaction ended up creating a big bubble of pride to defend the company. And teenagers took their savings out of their savings box and bought shares in the company. And of course, all of this was agitated by a lot of commentary on Reddit and this and that. And there was a weekend. Momentum trades happen very much on the weekend because market is closed, but people still talk. Actually, talk more than usual because they don't have to go to school, right? And then there was a big wave on Monday. Everybody was buying GameStop, and the company went from $20 like to $800, like in a few hours. I call that a momentum trade. It was a momentum trade for sure, but it's a very good example of the type of finance which has developed, which we've never seen before. I mentioned to you the case of that hedge fund whose job was to front run Korean housewives, and that's in the context in which I mentioned to you GameStop. But now these things happen very often. The collective of investors, sometimes tiny investors, gather power that create social trends. And social trends are making these momentum trades come and go very, very fast. Very, very fast. Like this momentum trade lasted about 3 days. So I like to use that as another example of momentum. I could have mentioned also ESG as a momentum trade. But I'll say much more about ESG is much more complicated. It's not only momentum trade. There's something else going on there. And I'll talk about that on Saturday. I remind you, until tomorrow, until Friday, I'll talk about the things that I know. And on Saturday, I'll talk about the things that I don't know. All the science fiction will be on Saturday. And the reason I do that is I suspect that's where the future is, and that's where a lot of you will be doing your career. So I want to help you with the things that I don't know, but I suspect I'm right. Okay? So it's all speculation and science fiction. That's a Saturday. Okay, so that's momentum trade. And it is one, there's another topic, which is the technical trading, this is what people do. Analyzing charts. They look at the chart, they say, this index is 10% down from the previous high, so it's getting into bear territory, it's gonna cross another 5%. And people have rules that explain how these things happen, and people have been doing that for a long time. These are people that follow rules. Of course, when you follow rules and everybody else follows the same rules, they tend to become a self-fulfilling prophecy. That's true. So there's a social element there. It's a bit of a momentum trade there also. But what's happening now is very interesting because a lot of those sentiments that people had are being now translated into algorithms. That's what happened in the year 2000. But now those algorithms are being translated into neural networks. And guess what? Some of them actually find something which is true. Many of them are just overfitting the data and said, oh, this is going to happen because the last 25 years told me that things are going to be like that. And guess what? It's not true. But some of them, they actually do find. And today, one of the things that I will show you in a few minutes is an AI, or machine learning methodology that is partly this, partly that. It's a bit of a hybrid between the two, and I'll show you. It's the Q-sum method that Marcos Lopez de Prado developed, and I'll show you. I'll explain that in a few minutes. But before I do that, let me remind you or explain to you, this is the first time you see that, what fundamental equity trading is. Fundamental equity trading is a style where you look at companies. I have some companies here, and then you look at their financial statements. You look at the things that matter to fundamental traders. For example, you look at the price to book. This is the actual price of the company in the market, and the book value according to the financial statements. Okay? If a company has a price to book, or say 5 times, that's very cheap. People think that's cheap. If it's 50 times, it's very expensive. So you like to buy cheap companies where the price to book is low, and sell companies where the price to book is expensive. Now, this is what fundamental traders would do. Of course, if what's the book value of a company called Facebook when they went to the IPO? They had no money, they had no revenue, and they had debt. So a fundamental trader will never buy them. But if you look at a company like Apple, Apple has a lot of cash, has lots of assets, has great sales, and 0 debt. So the price to book is very low. So people will consider it to be a good buy. Now, a price to book that I have here for, well, I have the PE, not have the price to book, I have the PE, 17. It's very high. But if you compare that with, for example, Microsoft, which is 30, it's about half. So many investors will consider Apple to be a better buy than Microsoft because the PE ratio is much lower. That's a fundamental approach to buying stocks. Okay? Now, there's a lot of numbers here. We have price to sales ratio, which is what are the sales number of this company and how much do I pay per dollar sold. That's the price to sales ratio. And when I see that Apple is very cheap, it's 2. Microsoft is 6. So compared to the number of sales they have, Apple is very low. And you can continue. And by the way, this is only a snapshot. You go to Bloomberg, there's hundreds of features like that. All of these come from financial information and then taking ratios between them, dividing between that and this and that. Okay? So fundamental equity traders trade on that. This developed 100 years ago, and 100 years ago, people did this with pen and paper, with a lot of, there were not even calculators, you had to divide by hand, right? And they draw the investment conclusions based on that. With the arrival of computers, you can do these things very quickly, but one thing you could not do until now is when I look at all of these possible combinations, you can say, well, what is really important and what really matters? People couldn't do that. But today we can. We just did it an hour ago. Right? So now, I mean, I know that you knew the technology, but now you know the application, which is with everything we've learned, we can take these to be my features and I can see which are the relevant ones, which are not the relevant ones, and how should I act based on that. I don't have to explain, we already saw that. Which in the context of credit card defaults, which in the context of company size and volatility, but now I have the context of all the accounting information. So you could do that on your own. And this is not something that I wrote down, but it just occurred to me. Given our recent discussion, if any one of you wants to say, oh, I'm going to get some of this data from Yahoo, and I want to run my analysis either with trees or sub-values or something, wonderful. I didn't think of that. It just occurred to me now. Okay? And you can all do it. And by doing that, you're already ahead of the 99% of the professional asset managers out there who don't even know what we're talking about. Okay? All right. So that's what it is. And I mean, these are the 5 that people use. These are the big ones. But how many are you here? Between here and here, there's about 30 of you. I am pretty sure that without any experience trading, many of you will come up with something better than these 5. If you have the right database with you. Okay? All right. So do you feel powerful now? Do you feel powerful? No? Alvaro feels powerful. Not yet? No? Okay. Okay. All right. Well, then let's continue. Okay? Then you need to feel powerful because, okay, so let me continue. Now let me talk about growth. Again, remember, growth was essentially introduced in the year 2000. Because up until then, people were very down to earth. But then when you see all these companies that exploded and became very successful, like all of a sudden, and we say, wow, we should have seen that. Why didn't we see that? Well, the financials look terrible. Yes, the financials look terrible, but we should have guessed that this company, was gonna do well. What could represent a company doing better? And I'll walk you through some of that. This is some of the things that people mentioned today make a good. So they look at a company and look at that. Sounds familiar, right? And by the way, I didn't put this. I did not make up that number, that table there. What is the table? It says the minimum historical growth in the last 5 years according to size. This is what growth investors would consider to be a threshold for a company to be in the growth category. Okay, so if you have a company between 400 million and 4 billion, break? No break. No break. Okay, continue a little longer, okay? Just a little longer. Okay, we'll take a break right before I start the QSUM factorization. All right. So this is in the growth trading manual. I just copy pasted it from some book. We've seen that before. We saw that today, in fact, right? These are the numbers which growth managers just look at before they classify a company as growth and then they buy it. This is the historical growth as a function of size. Now, I am sure that every one of you could actually come up with a better table than that. That's where we used the trees earlier today. You could do that. Okay, I'm not going to do it, but it not only sounds familiar, it sounds like even underpowering. You could do better. Okay? So these are some of the things that people look at. They would say, they look at what's called historical growth strength. Say, well, this has been growing very fast, so at some point it's going to explode. This is what, right? And then they look at the earnings growth, but they look at the forward earnings growth. They have a way of somehow figuring out what the forward earnings is going to be. And there are people who spend their time making projections for how these companies are going to grow. And if it's going to grow as a function of, say, bigger than 10%, now, of course, which are the features that will say whether 10% is right or wrong? You could do that better too. If I give you a data set, you can analyze the data set, and then you can come up with the right breakpoint will be, right? And then they look at other, what you may not know before today is which are the numbers to look at. And then they will look at earnings growth, they will look at efficiencies, costs, revenues, all of these things which are in the financial statements. So one of the things that I not to you, don't do this in this course, but one of the things that I ask some of my students in other courses is pick a company, get all the, analyze the financial statements with ChatGPT, get the data clean, build a database, and now you can start to implement these things directly out of the financial statements with a very simple agent that you can build. right? Well, people do this by hand. The example that I usually mentioned as a good example of growth, it hits everything, is Microsoft. And I'm going to show you this so that you see how the decision factors which are used to decide that this is a growth trade, an attractive growth trade, is actually something that will come out the output machine of the three methods that we developed earlier today. Every single one of these things are things that you can refine with a tree-based method. The first one is the historical growth strength. And here you analyze the historical growth of Microsoft compared to their peers. And you can see that the historical growth of Microsoft has been around 16%, whereas their peers of Microsoft have been about 10%. So they have a higher derivative of growth. That's considered to be an indication for a growth trade. Another one is the 5-year projected average annual earnings growth. It was 11%, and for Microsoft, and the company average was like 6 or something. So another thing that will trigger. And then another feature, I'll call them features now. People don't call them features. I'll call them features because then it's completely within the realm of what we did earlier today, is the cost and revenue control. And the cost and revenue control of Microsoft, again, it has, it's about twice as good as the rest of the industry. You don't need a neural network to know that this is better than the rest. But whether these are the right features, that's something that we can do now because we know how to do feature engineering now. Okay. And lastly, we have the return on equity. So the return on equity for Microsoft is, the last one is 16%. The 5-year average is 20%, whereas the average is 13%. Of course, it's much better than that. But now where you could all become very powerful is, this is another feature that you could identify as being relevant or not. And there are many, many others. These are the ones, the 4 ones that people typically use. But now you are not constrained to using only 4 because you know how to pick which are the right ones, given the right database. Everything I said so far, when I talk about trading strategy, is about going long. And what I told you here is mostly driven by going long. But no, going short is a very important complement to stock trading, as we will see that. Now, let me explain in the 15 minutes I have how shorting stock works. And then we're done with that, we understand, and then tomorrow I don't have to do it. I'll just explain to you now. The process of shorting stock, I have to assume that you don't know. It starts with the locate process. If you call your broker and you said that you want to short stock, the broker what the broker will do is will find available stock of a shareholder that they can loan, and then the broker will sell it, give you the cash, and then record in your ledger that you owe that stock to that particular shareholder. Okay? I don't know if you've seen the process. That's how it works. It's not buying a negative amount of stocks. You have to go through the locate process. It's very important. In fact, there are markets when once the stock is given to you, you cannot sell it immediately. You have to wait for the stock to go one tick up before you can sell it. Otherwise, it's illegal. In the United States, it was done like that in 1934. And up until 2007, it was illegal to sell your shorted stock until that tick happens, that sends the stock up. Okay, in the United States, that was repealed in 2007, but for example, in Japan, you still have that. And the reason is, these are some of the topics that were introduced to prevent market manipulation. But the most important feature for us is that if you short stock, the stock can be recalled. The owner of the stock can say, I want it back. And then you have to buy it and return it to them. Of course, if a particular owner of the stock wants it back and someone else is wanting to lend it to you, you don't even know. The broker will just swap the two stocks, return the cash to the one who wants to sell it, and you don't even know. But sometimes it happens that all of the owners of the stock want to sell it. And those who are short will have to buy it, typically at very high prices, to return it. And that's called a short squeeze. And in the 15 minutes I have, I'm just going to go and I'm going to tell you, you'll understand how this works with one example, which is what I'm doing now. I'm going to tell you the Volkswagen short squeeze, the most famous, perhaps the most famous short squeeze in history. You understand this, and then you start shorting. Okay, so let me tell you. And it's a good story. It's the right way to end my class today. Do you know the history of Porsche? Ferdinand Porsche was a German industrialist who was doing typically tractors and trucks and agricultural products at the beginning of the 20th century. During the Third Reich, when Hitler was in power, he developed the automobile division of Porsche. And Hitler forced him to sell that to the government, and that is what Volkswagen became. So Volkswagen became the nationalized automobile division of Porsche. And the story goes that Ferdinand Porsche made his family swear on his deathbed that no one will rest until Volkswagen is brought back into the Porsche family. Okay, so for the longest time, Porsche was a shareholder in Volkswagen, but was a minority shareholder. They had 42% of the company. 20% of the company was owned by the state of Lower Saxony. In 2008, look at the date, in 2008, 13% of the stock was on loan for shorts. 2008 was the year of the big crisis, and cars are the stock that most people go short when you're in a financial crisis. The reason is cars is the first thing people stop buying when they don't have money, and the first thing that companies stop buying when they don't have credit. It works like that. Back in 2008, if you look at the car sales numbers, the implied holding period for a car was, I believe, 27 years. That means that people will hold on to their car for 27 years. Do you know anybody who drives a 27-year-old car and is not Cuban? Do you know anybody? No, doesn't exist. Well, that was the period of time that cars will be projected to be on the road, 27 years. Every manager was short cars. We were short cars too. Okay, we were short Volkswagen. We were caught in this trade. I lived it from the first row. We were short. What about what's about to happen happened to us? Okay, so that's what I'm going to tell you. Now, back in October 24th, on Friday, things were very good, very comfortable for us because the float available for trade was 25%, which is much more than the daily volume. So what are you afraid of when you're short? You're afraid, first of all, that someone's going to buy the company and then the price just doubles. Or, and with someone owning 42%, well, it's difficult, especially given what was going on with the car company. But in any case, the volume is much lower than the money which is still available for shorting. So if something happens, you just buy your stock, return it to the owner, and you're okay. Now, on Sunday, the CIO, the Chief Investment Officer of Porsche, announced that they had purchased 31.5 options on Volkswagen. They saw that finally, after all these years, the dream of Ferdinand Porsche could come to reality and they could bring Volkswagen back into the Porsche family. And the announcement was made on October 26, 2008. By the way, for your information, around that time, General Motors was either bankrupt or about to go bankrupt. Chrysler was bankrupt or about to go bankrupt. Ford was about to go bankrupt. They didn't go bankrupt. It was just very bad for all the cars all over the world. Okay? And Porsche announced that they had bought cash-settled options to own the whole company. They were very happy about that. But a lot of people were very unhappy about that. We were one of them. because you notice what happens is that is now over 100%. And there was Sunday. So we knew what was going to happen on Monday. At the open, Frankfurt, 9 a.m., Volkswagen stock started to rise. Why? Because everybody was rushing to buy the stock and unwind your short. We were some of them. But what happens when people want to cover your shorts? What happens is that everybody's trying to buy the company to give it back, so the company goes up in price. When a company goes up in price, what happens to the original shareholders of the company? For the first time, they see a stock going up in all of 2008. So they want to sell it too. But some of those companies, some of those shares were on loan for shorts. So those who had not rushed to sell it, or who decided the price was already too high to sell, were forced to sell. And the result was that everybody was forced into selling, even those who were sort of like us. We didn't lose a lot of money, but we lost a little bit of money. And all the short sellers were were recalled on the loan. We had to return it. This is what is called a short squeeze. The company kept on rising, and at the end of the day, it rose 286%. It became, back then, we didn't have Apple or Google or any of that. Exxon was the biggest company in the planet. For a few hours, Volkswagen was the most expensive company in the planet. And the way it ended is really worthy of Hollywood. I wonder who's going to make the movie. Maybe if no one does it, maybe I'll do it. Because the story is fantastic. Not only started with Ferdinand Porsche, the way it ended was, you know about cars? Do you know, now Volkswagen owns Porsche now. So this created a tremendous revolt within Germany. I don't have access to all of the information that happened there, but what I do know is the bank that was the broker for that transaction was a Canadian bank, Maple Bank. They were the broker. A few years after that, the bank was raided by the German tax authorities. So when that happens, the bank has to close, because even if there's no allegations, it doesn't matter. Your counterparties decide to stop your line of credit, and the bank cannot work without a line of credit. Okay. The allegations were the dividends on the short dividends, which, when you talk to the people in the bank, said there was nonsense. That was not true. It doesn't matter if it's nonsense or not, because once the German tax authorities go after you, you're done. Okay. So was that some speculation whether that was a real crime or some political pressure? It's unknown. But the fact of the matter is that this bank ceased to exist, and Porsche somehow ceased to exist also. Volkswagen took it over. That's not part of the short squeeze that I wanted to tell you, but the short squeeze is one of the most interesting short squeezes in history. In fact, when I teach in Germany too, and for many years when I get the students to download some stock data and we do some calculations with it, I had to ask them to remove Volkswagen, because that event was so high that although it was only one day, it destroys all the calculations you try to do. It was a huge event, a big outlier. I told you about the effect of outliers yesterday. Well, Volkswagen is a big one. You have to remove it when you do that. It was such a big one. You know, 300% increase, 3 times the value of the company in a day, and it was all driven by that. So Porsche made $1 billion on that transaction, I'm told. It was the only car company that made money that year, but not by selling cars, but precisely because of this transaction. Okay, so shorting stocks is very, very risky, and it's something which is, well, I can tell you, there is a hedge fund I know in New York. It's a hedge fund run by 3 people. It's a very interesting case for the AI component of this course. It's three lawyers. They run the hedge fund, and all they do All they do is they short companies. That's all they do. And to short companies, what they do is they read the SEC filings, the Securities and Exchange Commission. What they do is they disclose their actions against companies because they suspect they did that, because they suspect they did that. So what they do is they read these things very quickly and say, oh my God, this company is in trouble. Then they short the company very quickly before the market gets in. You have to be very fast, right? Well, you can use LLM for that now, right? Just read the filing as soon as it's done, and the LLM, if it's a good one, within a few seconds will know if you should short the stock by how much and what's the price target. So if any one of you is thinking of creating a shorting business, that's a very good one that you can do with an LLM. Okay. All right. Short sellers always look at the short interest over the average daily volume. See, this number was very low for Volkswagen. That's where we were all caught off guard. This number will look very safe. What we did not know is that there was this massive transaction, 31% of the company, that was buried into these cash settled options. Okay. All right, so 57. I ended here. Today what I will do is I will find the missing graph that I need to explain what's going on with the Q sum. I'll finish that, which will not take me a long time, 10 minutes maybe. And then I will talk about equity long short, how we bring longs and shorts together, which is where the magic happens. Okay? See you tomorrow.